Good morning, everyone. My name is Mark Stone. I'm the managing partner of Sales Tax Defense. Our firm specializes in sales and use tax consulting. I'm a CPA. I have a master's in taxation. I also used to be a sales tax auditor for New York State. My partner, Jennifer Koo, is an attorney if you need legal help on this end. And we handle everything from advising clients what to charge tax on, where to charge tax, how to charge tax, to taking things up to Albany through the entire court system, up to the appellate court in Albany when the government says something should be taxable. And our clients, and in conjunction with our clients, we agree that the transaction is not subject to tax and that the New York State Tax Department got something wrong and you shouldn't be paying tax on the transaction. So today's presentation is really all about e-commerce and sales tax on the internet, or sales tax remotely. That's really the way to look at it, because sales tax itself on the internet is very, very simple. It's the rules around it on what you have to do to stay in compliance, which is much, much more complicated. So let me start with some basic rules. Let's go to the first page, actually. In New York, why do we even care about New York sales tax? What do we do that we have to follow the rules? Why do we have to follow the rules? Well, every state would like for every business to collect sales tax and send it to them. But most businesses don't collect sales tax in all 50 states or the 46 states plus District of Columbia that have sales tax. They only collect sales tax and remit sales tax in 1 or 2 states. Why? Because that's all they have to do. They don't have to do it any other place. And that comes about from a 1992 Supreme Court case, Quill versus the state of North Dakota. And what the Supreme Court said is that you have to have a physical presence in a state in order for that state to regulate you. That connection, that physical presence, is called nexus, N-E-X-U-S. And what nexus basically means is that you have a connection to a state, and since you have a connection to the state, that state can regulate you. And let's just stay with New York for now. New York says that our law is that there's a sales tax or a use tax, and that you, the business, have to collect the sales tax on certain transactions. And what it also says is that if you're a purchaser and for some reason the seller didn't charge you sales tax, then you have to pay a use tax directly to the government exactly equal to what the sales tax would have been, but that you didn't pay. And the use tax is supposed to be the safety net, if you want to call it that. For anyone that beats sales tax, you get stuck as the purchaser paying an equal amount of use tax. So even if the seller makes a mistake, you, the purchaser, don't get away from paying it. So we're very used to this physical presence test, because I'm going to make the assumption that 99% of the people on this call have a physical presence of their business in New York. Therefore, they have nexus in New York. Therefore, they have to follow the New York rules, which is, when applicable, collect sales tax, obviously remit the sales tax, and file a sales tax return. So here's the most important thing that I'm going to say in the entire presentation for the next hour. And if you only remember one thing that I say, this is it. Every business, which means every single business, which is every single solitary business without exception that's located in New York State, should be filing a New York State sales and use tax return. There are no exceptions to that. And you're going to tell me, well, I'm a teacher and tutoring isn't taxable. I'm a clown and I entertain children at birthday parties. That's not taxable. There's reasons for all of those different types of professions, whether you're a doctor, a lawyer, an accountant, a clown, a tutor, anything else, to be registered for sales tax, and at a minimum, filing an annual 0 sales and use tax return. What that does is it starts the statute of limitations. And if you made a mistake, if the clown forgot to pay sales tax or use tax when the clown bought a big red nose, if you're an accountant and you bought your laptop computer out of state and that seller didn't charge you sales tax and you forgot to pay use tax on it, it only gives the government 3 years to come back to you and say, whatever you did that was wrong is wrong. After 3 years, the book closes and the government's not allowed to change your tax return absent criminal fraud, basically. Short of them showing fraud, they can't reopen your books. So 99.9999999% of the time, unless the district attorney gets involved, if you're filing returns, the government has 3 years to audit you and make a change. Otherwise, it's closed and done. So that's the most important thing to remember, that every single business should be filing a sales and use tax return. And not just in New York, but in any state where you have nexus. So again, it's just staying with physical presence. If you have an office in New York and you have a satellite office in New Jersey, now you have physical presence in 2 states. So you need to now file in 2 states. And physical presence can come about from not just having an office, but it can come about from having traveling salespeople or service technicians traveling from state to state to state to do company business. It can come about from storing inventory in lots of different states. And that's a very important thing to remember, storing inventory, because we're going to come back to that in a little while. That's probably the biggest thing that's going to create a problem for a lot of people on this call, is the storage of inventory that you never really gave any thought to. Or any other type of physical presence in a different state creates nexus. Maybe going to a trade show, maybe flying out to train a new customer or do a software installation. All those different things create nexus. Nexus doesn't mean that you need to collect sales tax. Nexus just means you have to follow the rules. Until you have nexus, until you have a connection with the state, you can tell a state to go jump in the lake because they have no right to regulate you. If you got a bill from Russia saying that you need to pay Russian tax on something, you would throw the letter in the garbage. You would say Russia has no right to control me. If you get a letter from a state where you don't have nexus, you can do the same thing. You can basically ignore them. They have no right to regulate you. Once you have nexus, once that nexus comes about from a physical presence, or now being a remote seller, the internet, now you have to follow that state's rules. You might not have to collect tax on your transaction, but you must look at the rules in that state. You must make sure you understand the rules. Just because New York says that a loaf of bread is not subject to sales tax when you buy it, that doesn't mean Virginia says that a loaf of bread is not subject to sales tax when you buy it. So now you have to figure out what the rules are for your Virginia supermarket and not follow the rules that you're doing in your New York supermarket. Very, very important. So that's the baseline. That's physical presence. That's what we all know. That's what we lived with. That's brick and mortar stores is the expression. So what's changed? 2 years ago was a dramatic change in sales tax. So when it comes to the tax world, we'll call it a sales tax earthquake because it's been the biggest news since 1992. 2018, close to 30 years later, not quite 30 years later, the state of South Dakota went after 3 different companies. They went after Wayfair, they went after Overstock, and they went after Newegg. And what they said is that we don't care that you don't have physical presence in the state. You're doing enough business in our state that you have economic nexus, and that we're creating an environment for you that you wouldn't be able to make sales if not for the fact that we built roads, that we have policemen regulating things so things don't get stolen, that we have all of these state provided services that you're taking advantage of. And therefore, you have an obligation to follow our rules exactly the same way as if you had opened up a store here in our state. So Wayfair fought them, and Wayfair won against South Dakota in every single state court and every single federal court except the Supreme Court. In 2018, the Supreme Court decided the Wayfair decision. And what the Supreme Court said is a combination of 2 different things. Our 1992 decision of Quill was kind of wrong. And the reason that it's kind of wrong is that things have changed so dramatically with the creation and evolution and economic transformation that's taken place because of the internet, that it's not applicable law anymore. That this concept of economic nexus now being the same thing as physical presence and creating physical nexus is allowed. And they reversed themselves. They reversed the 1992 Supreme Court decision. And they said, now this is the law. And what the South Dakota law says is that in the preceding 12 months, if you've done either, excuse me, either $100,000 of sales into the state and or 200 transactions in the prior 12 months, from that point forward, not retroactively, from that point forward, you now have nexus in that state and you have to follow that state's rules. So now what do you do about that? So I have a couple of practical things that I think you have to do. I would say twice a year, you look at your sales. You run the sales by state for the last 12 months. You do that on December 31st and you do that on June 30th. And you look at your sales, and in any state where you have $100,000 or more of sales in that 12-month look back, you now need to get registered. I think it's unrealistic that you're looking at your sales every month or every day for all 50 states. I think it's going to just make a very burdensome administrative process. With regards to the transaction count, you should know that 200 transactions on the look back period also create nexus. However, the cost of administering sales tax for yourself, of registering, of collecting, of filing returns can be substantial. So if you're selling gumballs and you charge $1 a gumball and you sell 250 gumballs into a state, so you don't charge sales tax on $250 and sales tax is 10%, and the state sends you a bill for $25, you don't really worry about it. You pay the bill, and then maybe from that point forward, you do it right, because it's going to cost you a lot more than $25 a year to file returns in a state and be compliant in a state. So I like looking at the dollar threshold much more than the transaction threshold. However, if you do have lots of higher ticket dollar transactions, they're $500 a transaction or $350 a transaction, maybe you do want to be a little bit more careful with that. And if you have thousands and thousands of transactions that add up to something significant, you also want to be careful with that. But if you just have, again, 250 transactions and each transaction is $10, so it's $2,500 in sales, if you get a bill from a state for $250, it's probably not the end of the world. So you have to balance what you are supposed to do for compliance versus the cost of that compliance and the cost of non-compliance. So that's the first part of it, that there now is something called economic nexus, and that may create a requirement for you to collect, file, and remit sales tax in multiple states, multiple jurisdictions. Okay. The next piece that goes along with this, again, this is all remote sellers, internet related. It's next to impossible for a state, let's just pick on Texas, for example, to track down every New York company that's doing 201 transactions into the state of Texas. There's just no realistic way for them to do that. And you know what? There's no realistic way for them to enforce that, because if they're going to be sending out bills for $250, it costs them probably more than $250 to send out that bill, to track it, to collect on it, to keep it in their computer system. So they don't want to do that either. So a lot of states have come up with a rule that says that marketplace facilitators now have to collect the sales tax for their sellers. The best example of a marketplace facilitator is eBay. eBay actually doesn't sell anything. eBay, I'm going to call it, is a dating website. It brings buyers and sellers together and makes a match. And then they take care of processing basically the exchange. eBay uses PayPal or some other payment mechanism to collect the money and then remit it to the seller. And eBay kind of administers the whole thing to make sure that everybody plays relatively fairly. What the states say is that the marketplace facilitator actually needs to collect the sales tax on the sale and remit it. So if you're a New York business and you're selling on eBay, and eBay then collects the tax from New York State, what you do is you report your sale through eBay as a non-taxable sale for resale, because eBay is the person collecting and remitting the tax. And this way, if someone wants to do an audit, they have to audit eBay. They don't audit a million little sellers, they audit one company. And that makes it much easier for the governments to regulate everything. And eBay is not the only marketplace facilitator. Etsy, Amazon, in some cases, is a marketplace facilitator. But lots of different companies that have platforms that connect buyers and sellers are marketplace facilitators. And if you are a marketplace facilitator, you must understand the sales tax laws, because if you don't do it the right way, you're taking on the sales tax responsibility for hundreds, if not thousands of people. And sales tax is a fiduciary responsibility that you're personally liable for. And that can result in a bill to you of hundreds of thousands of dollars of money that you've never collected that other people were supposed to pay, and now that you get stuck paying. So if you don't know what the rules are and you're a marketplace facilitator and you're not following them, please reach out to me after this presentation. It's really something to be very careful of. The next big thing, fulfillment services. Everybody's heard of Amazon, or at least I'm going to make the assumption everybody's heard of this little company called Amazon. Whether Jeff Bezos is the richest person in the world or the second richest person in the world, he's doing pretty well for himself. He came up with this concept that Amazon would set up a big warehouse out in Washington State and then sell all over the country. And it's grown and grown and grown and grown. And by now, Amazon's biggest source of sales is that they provide fulfillment services and they actually sell for other people. So, and the amazing part of Amazon, if I want to sell coasters that are sitting here on my conference room table, they're going to get it to the customer in a day or two. Whereas if I was shipping out of my Dix Hills office here, and I had a customer in Los Angeles, it might take me a week to get my coffee coasters from New York to Los Angeles. So how does Amazon get it there in 1 or 2 days? And they get it everywhere in the country in 1 or 2 days. Well, if I want Amazon to do my fulfillment for me, so I don't need a warehouse, so I don't need people picking and packing these things, and this probably applies to lots of small businesses that are listening to this presentation right now, you send your inventory to Amazon. Amazon says to you, I need 500 coasters. And you ship it to a location currently in Pennsylvania, pretty soon in New York. And then New York takes your 500 items and breaks it into 50 lots of 10 each. Or really, they break it into about 30 lots of about 10, of 10 or 15 each. And they ship it all over the country. And they store your inventory in Amazon's 30 or 35 different distribution facilities all over the country. So now what do you have? You have your inventory in 35 different states. That's nothing to do with the internet. That's an old-fashioned 1992 rule that's still in effect, that you have a physical presence in 35 states. You now have Nexus in 35 states. You now have an obligation to file, collect, and remit as applicable in those 35 states. Now, Amazon will collect the sales tax for you if you're a FBA seller, but they won't remit the sales tax for you. They turn it over to you, and then it's your job to get it to the states where they've collected the tax or where you've turned on tax collection. Again, though, you may not want to be filing an annual return in the state of Wyoming to remit $6 in Wyoming sales tax. So therefore, you may take the risk and turn off sales tax in Wyoming and only want to comply maybe in your biggest states, New York, Florida, Texas, California, and Illinois. Those are typically the 5 biggest states that you have to worry about. Everyone's business is unique. It's important for everyone to do it the right way. But again, you have to weigh your costs of a $6 sales tax return versus the cost of registering, filing, tracking, bookkeeping, and then remitting that tax to Wyoming. So you have to make a business decision. So you want to go to the next slide? I can. So I want to kind of just reiterate this, because this is, again, the key to the whole thing. There's two completely different issues. The first issue is nexus. Do I have to follow the rules? How am I connected to that state? What am I doing that allows that state to regulate me? And that's my example going back to Russia. Russia mails us a letter, we throw it in the garbage because they have no right to regulate us. Once we have a connection to that state, whether that connection comes from having an office or employees or traveling salespeople or storing our inventory in that state, or from having an economic nexus, which again is that $100,000, 200 transaction threshold. Whether I have a connection because I'm a marketplace facilitator, or the one other thing that I didn't touch is because I have an affiliate in that state soliciting sales on my behalf, or that I'm paying some type of commission for, that can create nexus for me in that state. And then I have to follow that state's rules. The second question is, now that I have nexus in the state, now that I have to follow the rules, what is the taxability? Do I have to charge tax? Is it exempt? Do I just need to get an exemption certificate? Am I not allowed to accept an exemption certificate? So there's all sorts of different rules that play into it once you have nexus in a jurisdiction. So keep those two things very separate. First, do I have to follow the rules? Then only if I have to follow the rules, what are the rules? Okay. So moving on to the next slide. So how do I follow the rules? This is the very burdensome part about everything. So every state needs to keep track of who's doing business in the state. So there's a number of registrations that need to take place. The first registration is that you need to register with that state's Secretary of State in order to be allowed to do business there. And every business generally has a home state. So if you're a New York company, you're a New York domestic company with the New York Secretary of State. So in order to register to do business in New Jersey, you would have to register with the New Jersey Secretary of State as a foreign corporation. Foreign doesn't mean overseas. Foreign just means that you weren't initially set up in New Jersey. That's all that would mean. In order to register as a foreign business doing business in the state of New Jersey, you need to go to your home state's Secretary of State and ask them for a certificate of good standing to send to the other state, the foreign state's Secretary of State. Now you're registered in New Jersey and you're allowed to do business in New Jersey, and you realize that you have an obligation to file sales tax returns in New Jersey. Step 2 of that process is now going to the New Jersey the New Jersey Division of Taxation, the New Jersey Tax Department, we'll call it the IRS of New Jersey, and doing a second registration with the New Jersey Division of Taxation, saying, I would like permission to collect and remit sales tax in New Jersey. So that's just getting registered. And you should expect to spend somewhere between 2 and 4, maybe 2 and 5 hours getting registered with the Secretary of State, and very similar, probably between 2 and 4 hours getting registered with the tax department in that state. So you probably have a day's worth of work filling out forms and getting the supporting paperwork just to get registered in each state that you're going to do business. Maybe if you're registering in 10 states all at the same time, you'll have all the paperwork in front of you. It won't take you 10 days, but it'll take you a couple of days to get properly registered everywhere. All right, now I'm registered. The next step is I need to collect sales tax. How do I collect sales tax? Well, you just add it to the bill. But how much sales tax do I add to the bill? So again, let me use New York as the example. So New York has basically a different sales tax rate in every county. So a lot of us are here on the island. So we know that in Nassau and Suffolk, the sales tax rate is 8 5/8%, 8.625%. However, in Queens and the 5 boroughs of New York City, the sales tax rate is 8 7/8%, 8.875%. 8.8, yes, 75%. I think that's what it is. So along those lines, how do you know whether your customer, the point of delivery, is located in Nassau or Queens? Well, we live here. Maybe we can, just from our own knowledge, figure out whether Little Neck is in Nassau County or in Queens. Maybe we can figure out whether Farmingdale is in Nassau or Suffolk. But what happens when we go upstate and now you start getting addresses that are in the middle of the forest, in the middle of New York State? A lot of us from downstate are not going to know what county those addresses are in. And now if you have nexus in the state of Texas, if you have nexus in the state of California, you certainly don't know all the different cities and transit jurisdictions and counties in Texas and California that make up all of their different sales tax rates. Maybe you get lucky, it's a state like New Jersey or Connecticut that have a single statewide sales tax rate that makes it much better. But most of the larger states, New York, Florida, Texas, California, Illinois, have either city-specific sales tax rates or county-specific sales tax rates. So you need to find a way to come in compliance with that. So there's ways to estimate that you get it 95% right. 95% right is still 5% wrong, but 95% right is better than doing nothing. So we could talk about that offline if anybody has any questions. Or the alternative is just to do it the right way. The right way is either to let Amazon collect the tax for you. They know the right tax rates. Go out and buy a piece of software. There's a company called Avalara that integrates with your billing system that will help you collect the right sales tax rate. There's other programs called TaxJar, Vertex, TaxWare, all that do similar things. All of those software programs on the low side cost thousands of dollars to do. More realistically, probably cost tens of thousands of dollars to do. So you have to make sure that it's worth the investment for your size business to do it 100% correctly. But if you have nexus in a jurisdiction and you fail to collect tax when you're supposed to collect tax, the state, whatever state it is, does have the right to come back to your business and say, we don't care that you didn't collect it. You still had an obligation to pay it. Therefore, you owe us the tax, you owe us interest, and you owe us penalties on all of that money that that you should have collected and remitted, but never did collect. So you figure out a way to collect the right amount of sales tax. All right, or Amazon collects it for you and sends it to you. Well, now what do? You're not allowed to take that money and go to Atlantic City with it. You're especially not allowed to do that now during COVID. So therefore, you need to find a way to get that money to the state. And you can't just send the state a check, because as much as probably Cuomo would like to receive checks in the mail, if he doesn't know what to do with the money, it's just going to create more problems. So obviously you have to file a return with the remittance. And so how do you do that? So again, you either need to download the paper return and go through your accounting system and accumulate the data, and then figure out where it goes. Because again, if it's New York State, there's a line for Suffolk County, there's a line for Nassau County, there's a line for New York City. So you need to figure out where to put your sales and where to put the amount of sales tax that you've collected. Or, again, you need to buy software from Avalara or TaxJar or somebody else that will file the returns for you. Or you need to hire a professional, your accountant, my firm, someone that can then file the returns for you, possibly like we can take your sales data in an Excel file or an export it to a CSV file and use that data and use our own software to prepare and file the returns. And then of course to remit the tax. Generally remitting the tax now is all done electronically. You give the government a bank account number and a routing number, and they pull the money out when the return is processed. So that's really the big parts of staying in compliance. Of course, you need to know what to charge sales tax on. That's very important. You cannot assume that just because I charge sales tax in New York, that I charge sales tax in another state. And even more so, you cannot ever assume just because I don't charge sales tax in New York, that I don't have to charge sales tax in another state. If your customer doesn't want to pay tax, they need to give you exemption documentation. It doesn't matter. It's not your job to be the sales tax police. If your customer gives you an exemption document, as long as the exemption document looks valid, as long as it's completely filled out, as long as you take it in good faith and you receive it timely, which is generally within 90 days of the date of sale, but I'm telling you that you should get it by the day that you sell something, the day you do the invoicing. The government is generally going to hold you harmless because you got the documentation, and they're going to go after the customer, the purchaser, who didn't pay the tax. Keep in mind that if you have lots and lots and lots and lots of non-taxable sales, you're going to end up reporting to the government, to make up a number, $1 million in gross sales, $1 in taxable sales, and $999,000 in non-taxable sales. Well, the government is likely to audit you because they're going to want to understand why you're never charging sales tax. And they're going to see if they can catch you either playing games or not keeping the exemption documents. So that's why that paperwork is really so important. You really want to either charge the tax or get a valid piece of paperwork. Very important. Okay. Oh, thank you.
Good.
The only other thing that I didn't cover was something called an offer in compromise. An offer in compromise is when you owe the government money and you say, listen, I understand they owe you $1 million, but you know what? My business went out of business. My in-laws are willing to lend me $250,000. I already lost my house. I went through a personal bankruptcy. I have nothing left for you to take. So your choices are to mail me a bill every year for the next 20 years, or do you know what? Let's settle. Let's do an offer in compromise, and I'll come up with $250,000, and you accept that as payment in full for the $1 million that I owe you. It's a complicated process with New York State. It works better when that liability is a little bit older, and New York State's tried to collect on it and they failed. Unfortunately, the more broke you are, the better the program works. Of course, you still need to come up with some money at the end of the program to settle with them. And when you're the most broke, which is the best time to settle with them, you don't have the money to settle with them. As business starts to improve and you go to settle with them, the amount of money they want to settle goes up. So it's kind of a catch-22 where really the best scenario is you're out of business, you're broke, and your in-laws are going to lend you the money. So again, and we can talk about something like that offline, how the best way there is to present that scenario to the state, because a lot of what goes into that is making the right presentation to the government to get them to accept your settlement.
So if you're incorporated and you're not personally liable, right? And you close the corporation, what happens then?
Sales tax and payroll taxes you are personally liable for, and sales tax and payroll taxes are not discharged in bankruptcy. So you still have to deal with it after the business. Okay. So the next thing is staying out of trouble. If a state doesn't know about you until you're ready to, be in compliance in that state, try to stay below the radar. Don't start applying for business licenses and permits in the state. Assume that all the computers are connected in a state. So once you put your name in one computer, it's in every computer in that state. So be careful about that. That goes along with filing for one tax type. Really should file for all tax types because you're clearly in the computer. And if the state mails you a questionnaire, nothing good comes from a government mailing you something. They don't send out birthday cards or thank you letters. Everything they send to you is always bad news. So when they send you a Nexus questionnaire saying, are you doing business in our state? Make sure your accountant or your lawyer answers that. You can only get in trouble with that kind of stuff. You can't do it right. You can only do it wrong. So the best thing to do is really be in full compliance or try to avoid a state completely. So that's staying out of trouble.
All I can say is I think that there are probably people here who are quite nervous about what they're learning today. Go ahead.
Yeah, lots of bad. So this is the good news, this page, the refund page, and I'm going to try to end on a good note. There are times that you can actually get sales tax money back. And when I say getting sales tax money back, in almost every case, it's when you're the purchaser, not when you're the seller. So when you purchase things and you use them in a specific way, a lot of times the government says you didn't need to pay sales tax on that. And just these are some, for examples. If you're a contractor and you buy materials in New York, but then install them in another state, New York will give you that sales tax back on the materials that you installed in another state. In New York, if you buy machinery and equipment and you use it either in the manufacturing process or in the research and development process, or you have repairs or supplies or replacement parts to that machinery or equipment, that's all exempt from sales tax. You can get that sales tax back from New York State. New York has exemptions for printed promotional material. California has exemptions for startup companies. New York has exemptions for when you get money from the IDA and use that to expand your business. If you're a seller and you've remitted the sales tax on a sale and then ultimately your customer doesn't pay you, since you didn't get paid, you're entitled to get the sales tax back from the government since you never got that from your customer. Sometimes when you do business with exempt entities, churches, temples, school districts, fire departments, you don't need to pay sales tax on your supplies that you buy to do business with them. And then just a last thing, which is really staying out of trouble. Sales tax should really always be separately stated, and please separate as line items or on separate invoices the taxable sales from the non-taxable sales. On your invoice, don't say Yoo-hoo and chocolate milk $2. Say Yoo-hoo $1, chocolate milk $1. So the state doesn't have to guess what you're selling each item for. So these are some positive things, if there is such a thing as positive things with sales tax. And then on the very last page is a beautiful picture of me and how you can get in touch with everybody at my firm. So
that's great, Mark. I love your little, whatever it's called, avatar, I guess. I don't know.
Sure.
That's cool. Thank you, Mark. You've been fantastic.
Mark, this was great.
It really is great. It really, really is. Thank you, everyone, for attending. And if you have any questions, reach out to me. We'll help you. Make an appointment. We'll help you. Anything else? Thank you, everyone. Mark, thanks a lot.
Oh, you're welcome.
Great.
Thank you.
Great. Thank you.